7 years before the world watched in horror as the Twin Towers fell, a different kind of collapse was brewing. September 2008. A 158-year-old bank, Lehman Brothers, vanished overnight. $600 billion in market value evaporated. Retirement accounts, gone. Millions of jobs, lost. The global economy teetered on the brink of total meltdown. But what if I told you the real reason for this catastrophe wasn't some complex financial instrument, but a simple lie? A lie so powerful it could fit on a billboard. Become a homeowner instead of paying rent. Let's rewind to 2002. America is reeling. The dot-com bubble has burst, and the shock of 9/11 has sent shivers through the economy. Wall Street is a ghost town, but the Federal Reserve has a plan, a magic wand to fix everything, slash interest rates to almost zero. Suddenly, money became incredibly cheap. Borrowing became as easy as ordering a pizza. And just like that, America found a new national pastime. Forget baseball, everyone started buying houses. Picture this scene playing out all over the country. A young couple sits nervously in a lender's office. Congratulations, the lender beams. Your $500,000 loan is approved. The couple is stunned. But we only make $40,000 a year combined. The lender just smiles. No problem. We've got adjustable rate mortgages, balloon payments, and my personal favorite, the ninja loan. A ninja loan? What's that? No income, no job, no assets. You heard me. No income, no job, no assets. No problem. In the early 2000s, owning a home wasn't just about having a roof over your head. It was the American dream packaged and sold with a white picket fence. It meant stability, status, suburban bliss. Every commercial, every billboard, every mortgage seminar hammered home the same message. Stop wasting money on rent and start building equity. Banks believed this so fervently, they started throwing money at people like they were on a game show. This led to the birth of something called subprime mortgages. The name sounds technical, but the translation is simple. Loans given to people with bad credit, unstable income, or a very vague understanding of what money even is. Do you have a terrible credit score? Or no credit score at all? Are you currently living in a van down by the river? Well, congratulations, a luxury condo is waiting just for you. You might be thinking, shouldn't I be worried about paying this back? The lenders would just wave it off. Don't worry about it, it's not your problem. If you can't pay, we'll just sell the house for more money than you bought it for. This thinking ignited a housing gold rush. Everyone was buying. Prices skyrocketed. Your neighbor's house that they bought for $200,000 was suddenly worth $400,000 just 6 months later. Was this normal? In this new reality, absolutely. Even part-time McDonald's employees and baristas with $5 in their savings account were getting massive loans approved. Traditional credit standards? Thrown out the window. Risk assessments? Too boring. A down payment? That's optional now. If you had a pulse, you qualified for a mortgage. People started buying houses like they were ordering fast food. Lenders were printing credit like it was monopoly money. Mortgage brokers were racking up huge commissions, all while pretending not to hear the word bubble. Everyone, from the mailman to the Wall Street CEO, was operating on a single blind faith. Housing prices always go up. Because for decades, they always had, until they didn't. Underneath all the gleam of granite countertops and the excitement of open house tours, a tiny, nagging question lurked in the shadows. What could possibly go wrong? Spoiler alert, everything. By 2005, the game had changed completely. Buying a house was no longer about finding a place to live and raise a family. It was about flipping it like a pancake, hoping the next buyer would pay double what you did. Real estate wasn't shelter anymore. It was a lottery ticket. People weren't just buying one home, they were buying 2, 3, 4, with no intention of ever living in them. They were gambling, and the entire global economy was the casino. What happened when the music stopped and everyone realized there were no chairs left? That's the story of how this house of cards came crashing down. Stick around for part 2 to see how the whole world paid the price. Thanks for watching, and don't forget to subscribe. Ever heard stuff like this? I teach phonetics during the day, I buy apartments at night. I just bought my 3rd house with 0 down payment. I don't even live in any of them. Here's your latte, sorry. My bank just called. They offered me another penthouse in Miami. This wasn't just investing. It was a full-blown national obsession. The formula seemed simple. Buy a house, flip it for a profit, and repeat. The more people who got involved, the higher the prices went. The higher the prices went, the more people rushed in to get a piece of the action. It was like trying to put out a fire with gasoline, and everyone seemed to have a match. But underneath this red-hot exterior, the whole system was completely rotten. Those mortgages everyone was getting, they were called subprime mortgages, and they were incredibly risky. We're talking high-risk loans with very little documentation and barely any verification of income or debt. But Wall Street had a magic trick. They gathered all this garbage together, slapped a fancy label on it, and sold it to investors as a super safe investment, introducing mortgage-backed securities. Now with 80% more lies. So, how do you turn a pile of toxic loans into gold? It's actually pretty easy. You just get the official rating agencies to call them A2A, the highest possible rating. It's like someone saying, hey, this investment is full of bankrupt baristas and unemployed gym teachers. And the agency replying, looks okay to me. Now here's the part they didn't put in the glossy brochures. The rating agencies were being paid by the very same banks they were supposed to be rating. Imagine hiring a food critic, but telling them you'll only pay them if they give your raw chicken a Michelin star. Behind closed doors, even the rating agencies knew these packages were a sack of, well, you know. But Wall Street wasn't done yet. They took those shaky mortgage packages and mixed them into something even more complex and confusing. CDOs, or collateralized debt obligations. Through some kind of dark financial alchemy, junk loans were magically transformed into investment-grade assets that everyone wanted to buy. Actually, not everyone was fooled. A handful of investors, the quirky ones, the skeptics, the people who actually read the fine print, saw the rot beneath the boom, and instead of buying into the hype, they asked a bold question. What if we bet against it? The problem was, there was no way to do that. No product existed that would let you short the housing market. So these investors walked right into Wall Street's marble fortresses and said, look, these loans are garbage. We want to bet against them. Can you create a financial product that pays us when they inevitably fail? The big banks thought it was hilarious. You want to bet against the housing market? Oh, that's so sweet. Okay, you want insurance? We'll write it. You pay us a monthly premium, and when nothing happens, we just pocket the cash. Everyone wins, especially us. It's not like the entire system is going to collapse, right? Wall Street smelled easy money. They didn't believe the market would ever go down, but they loved the idea of getting paid constantly for insuring something they thought could never fail. So they got to work and cooked up the very instrument that would eventually blow up the entire world economy. The credit default swap. It was the perfect bet for the skeptics, and for the banks, the perfect trap. They were building a bomb and didn't even realize they were sitting on top of it. What happened next changed the world forever. Ever heard of credit default swaps? Imagine them as insurance contracts. They paid out if those complex mortgage-backed investments went sour. But here's the crazy part. You didn't even have to own the investment to buy the insurance. It was like buying life insurance on your neighbor's grandmother and then, well, hoping she wasn't too careful on the stairs. The entire financial system became a giant Jenga tower, precariously built with lies and leverage. Each block was a bad mortgage, and each layer a bigger, riskier bet. Meanwhile, at the top, the mood was celebratory. Cheers to another record bonus. Who needs ethics when the money flows this easily? The few who tried to sound the alarm, the whistleblowers, were simply ignored. Regulators seemed to be fast asleep at the wheel. And the people in charge? They were far too greedy to stop the party and way too rich to care about the consequences. As the champagne popped, the ground beneath them began to quietly crack. It started as just a whisper, a missed mortgage payment here, a foreclosure sign there, an empty apartment in Vegas, small signs that something was wrong. But then, the whisper grew into a roar. The wave finally came, bringing with it a headline that was once unthinkable. House prices are falling. For years, the mantra was, housing always goes up, that's basic economics. But the market was defying its own golden rule. The Jenga tower, built on lies, leverage, and a whole lot of blind optimism, was starting to wobble. In 2007, someone pulled the wrong block. Those subprime loans, the really risky, rotten deals given to people who couldn't afford them, started to default in massive numbers. And the mortgage-backed securities, those complex financial products built on top of them, turned out to be ticking time bombs. And then, they exploded. Banks that thought their portfolios were stuffed with super-safe, AAA-rated assets suddenly realized they were holding radioactive garbage. What they thought was gold was actually financial plutonium. Panic spread through Wall Street like wildfire. "We can't sell this garbage!" traders would scream. The market had completely seized up. Investment banks started reporting billions in losses. Hedge funds were bleeding out. And then came the big one, the explosion that shook the world. Lehman Brothers, a financial titan, a 158-year-old institution, was gone. Vanished. The government decided against a bailout. No hero swooped in to save the day. All that was left was a $600 billion crater right in the middle of the global financial system. The message to the market was terrifyingly clear. If a giant like Lehman can die, anyone can die. The trust that holds the entire banking system together evaporated overnight. Banks simply stopped lending to each other. The credit markets, the lifeblood of the global economy, completely froze. It was like someone had pulled the plug on the entire world's financial engine. From giant corporations needing loans to run their business to regular people just trying to get by, the flow of money stopped. The party was officially over, and the hangover was about to begin for everyone. This wasn't just a Wall Street problem anymore. It was about to become everyone's problem. What does this mean? It means we're closed. Good luck. Suddenly, everything just jammed. Families couldn't get mortgages, businesses couldn't make payroll, investors tried to pull their money out, but there was nothing to pull. Retirees watched their pensions evaporate in real time. 401ks? Toast? Life savings? Gone. The job market just vanished. By the end of 2008, the economy was in full collapse. Millions were unemployed. Foreclosures skyrocketed, and eviction notices piled up like junk mail. The unemployment offices looked more like disaster relief camps. This wasn't just a Wall Street problem. Main Street was in freefall. And the chaos didn't stop at the US border. Iceland's major banks collapsed. Tokyo stocks plummeted. European leaders were in a full-blown panic. From London to Reykjavik, from Tokyo to Sao Paulo, markets crashed, banks buckled, and global economies spiraled downward. The question was no longer, who's next? It was, is the entire system broken? The Great Recession had officially begun. The US government faced an impossible choice: let the whole system burn to the ground, or throw billions of taxpayer dollars at the very people who lit the match. In October 2008, they chose the latter. The request was staggering. I need $700 billion. For what? To shovel into the burning banks before the whole thing exploded. This was TARP, the Troubled Asset Relief Program. Essentially, they were giving Wall Street a $700 billion cushion. Why? Because the banks were too big to fail. If they went down, they would take the entire global economy with them. So the government did what it felt it had to do. It started dropping money from helicopters, loans, bailouts, stock buyouts. If there was smoke coming from your balance sheet, Uncle Sam showed up with a fire hose. But it wasn't just the banks. AIG, the insurance giant that had gambled trillions on garbage assets, got over $180 billion in aid. Even GM and Chrysler got a rescue package worth $80 billion. It was economic triage on a scale not seen since the Great Depression. Meanwhile, at the Federal Reserve, Ben Bernanke slashed interest rates to near zero. And then came the big one: quantitative easing. The Fed literally started printing money out of thin air to buy up bad bonds and mortgage junk. It was like trying to patch up the Titanic with $100 bills. And believe it or not, on some level, it worked. The markets calmed down. The banks stopped panicking. The stock market hit rock bottom in March 2009 and slowly, painfully, began to crawl back up. Wall Street breathed a huge sigh of relief, but Main Street was still choking on the smoke. The human cost was brutal. Unemployment hit 10%. 8 million jobs were gone. 4 million homes were foreclosed. $19 trillion in household wealth vanished into thin air. Families who had never missed a single payment suddenly owed more on their homes than the homes were even worth. And people were furious. Wall Street bonuses are back. You'd hear people say, I just got evicted and they're getting bonuses? The people who caused the crash were rescued. The people who played by the rules got pink slips and food stamps. Wall Street popped champagne, while Main Street stood in soup lines. And then the anger boiled over. In 2011, in Zuccotti Park, New York City, thousands gathered. Tents, drums, and cardboard signs filled the space. One sign captured the feeling perfectly. We are the 99%. This was about more than just bailouts. It was about a system that felt rigged to protect the powerful. Profits were privatized, but the losses were socialized, and there was a complete absence of justice. Not a single major Wall Street CEO went to jail. No perp walks, no handcuffs, just golden parachutes and quiet retirements. The system survived, but our trust in it was burned to ashes. A generation grew up learning a harsh lesson. When the banks fail, they get bailed out. When you fail, you get ruined. If 2008 taught us anything, it's that the next crisis probably won't look like the last one. It will seem harmless, profitable, even inevitable, until suddenly it isn't. Thanks for watching. If this story resonated with you, hit that like button and subscribe for more deep dives into the events that shape our world.